Welcome to The Explainer. Today we're unpacking a really fascinating and honestly highly consequential paper out of UCL. It's titled Retail Central Bank Digital Currency, Motivations, Opportunities, and Mistakes. Basically, we're looking at how the underlying tech choices we're making right now are going to fundamentally define our financial freedom tomorrow.
So think about this for a second. In a cashless future, will you truly own your money? We are literally standing at an irreversible fork in the road. As physical cash kind of just fades from our daily lives and digital payments take over, the whole idea of what it actually means to possess and control wealth, well, it's being entirely rewritten by governments and institutions all over the world.
Okay, let's dive into this. Here's our roadmap for today. First, a new form of money. Second, we'll review the global proposals. Third, the core design conflicts. Fourth, why institutions actually want CBDCs. And fifth, the cash-like alternative.
Section 1. A new form of money, the shift from cash to digital. As the researchers point out right off the bat, there's just a rapid, undeniable drop in people using physical central bank money, cash, for everyday retail transactions, and it's being heavily replaced by private sector digital credit.
Now, you've probably heard the acronym CBDC thrown around, but the authors are specifically zeroing in on retail CBDCs. We aren't talking about massive wholesale interbank settlements here. We're talking about digital money meant for routine, everyday commerce by you and me. It's currency issued directly by central banks, designed to sit right alongside physical cash.
To really get a grip on the stakes here, it's literally the difference between handing over a crumpled $20 bill and swiping your debit card. With physical cash, you have direct possession, right? No middlemen whatsoever. But the digital bank money we use right now, that relies entirely on custodial accounts. You're basically asking a bank to move funds for you, which inherently opens you up to data harvesting and profiling risks. It's kind of ironic, isn't it? Handing over a $20 bill actually gives you way more robust privacy than our most advanced digital payment systems.
Moving on to Section 2, reviewing the global proposals, what's on the table. Let's take an objective look at what heavy hitters like the US, the UK, and the EU are actually building as they design their digital currencies.
Now, what's really interesting about this is the striking similarity across the board. The researchers highlight that whether you're looking at the digital dollar, the digital pound, or the digital euro, they all lean heavily on intermediary accounts. You aren't holding the money directly yourself. On top of that, across all three proposals, privacy takes a backseat to transparency, meaning the authorities or middlemen can absolutely de-anonymize who's paying for what. And finally, they're all looking to slap strict holding limits on everyday users, mostly to stop everyone from pulling their money out of traditional banks all at once.
Section 3, the core design conflicts, the fork in the road. The authors argue these proposals are creating some incredibly deep, fundamental tensions about how public digital money should actually work. This is exactly where highly technical decisions transform into major societal policies.
Right at the heart of this is a highly technical debate: account balances versus true digital tokens. See, a balance is account-based. That means a central ledger has to update your specific number, which permanently links your money to an identifier and tracks your history. A token, on the other hand, acts way more like true digital cash. It's a distinct digital asset unlocked by cryptographic keys, and successive transactions don't necessarily have to link back to a central identity. So why does this matter? Because this technical ledger choice dictates whether you're basically just a tracked account number or a private citizen actually holding digital cash.
This architectural choice sets off a massive tug-of-war between anonymity and transparency. On one end, you've got the argument for a citizen's right to privacy, keeping our transactions totally free from state surveillance and corporate data mining. But on the flip side, authorities push heavily for transparency. They insist that identity absolutely must be tied to transactions to stop illicit finance, deter crime, and enforce tax laws. The source paper points out that governments almost always frame privacy and compliance as values that are fundamentally at odds with each other.
So the crucial point is, it all boils down to custody. Direct custody means you independently possess and control your own assets, full stop. But the intermediary models being proposed globally, they mean your assets live in a custodial wallet managed by third parties. And that makes them subject to external rules, restrictions, and even potential freezes, which we've definitely seen happen globally in recent years. The researchers pose a pretty chilling question here. If an intermediary holds your digital currency and has the power to block your access, is it truly your money?
Let's jump to Section 4. Why institutions want CBDCs, the driving forces. If these designs heavily restrict the end user, why is there such a massive urgency to roll them out? Let's explore the motivations outlined in the research.
Well, central banks desperately want to maintain their monetary sovereignty against foreign digital currencies. They're also playing defense against private stablecoins and those massive closed-loop corporate systems like Alipay, WeChat Pay, which totally bypass traditional banking. Third, there are huge lobbying opportunities for incumbent banks and big tech data harvesters who really want to protect their business models. Then, of course, there's enhanced crime prevention and tax enforcement. And finally, there's what the authors vividly call the panopticon effect. That's the institutional comfort that comes with having sweeping surveillance and absolute control over all financial flows.
Let's move to Section 5 and see how this builds. The cash-like alternative, a missed opportunity? Given these heavily surveyed proposals, the UCL researchers strongly believe there's a completely different path available to us. Mapping out the author's payment universe here, the top half represents our digital status quo. See how locked down it is? Things like card payments and interbank transfers rely exclusively on custodial account-based mechanisms. You are always asking a middleman to move your money. And this brilliantly illustrates the exact opposite. The physical realm of cash and bearer vouchers operates entirely, completely outside of those custodial relationships. If you physically hold the cash, you hold the value. There are no accounts, no intermediaries, and absolutely no systemic tracking logging your every single purchase.
Which brings us to what the authors argue is a massive missed opportunity by global powers. They're proposing a true middle ground, a token-based digital cash. We're talking about a non-custodial digital currency that lives directly on your device. It would allow you to possess it directly and transact without any middleman holding your funds or tracking your behavior.
To actually achieve this vision, the researchers lay out their desiderata, their absolute non-negotiable requirements for a truly pro-consumer CBDC. First, it has to be non-discriminatory by design. Second, it needs real baked-in privacy for payers, using actual cryptography, not just a promise from a bank that they won't look. Third, it must allow direct possession and control by the consumer. And lastly, it needs an open architecture, so users aren't forced to rely on certified proprietary hardware from massive tech giants just to use their own money.
As we wrap up, I want to leave you with this to ponder. We are digitizing the very foundation of the global economy. So when money goes entirely digital, who should set the rules? Will it be designed to empower your privacy and true ownership, or will it be structured just to serve institutional control? The choices made right now are going to affect absolutely all of us.